The market is currently closed, and Nokia stock finished its most recent live regular trading session on Friday, May 29, 2026, at an exact closing price of $14.84 per share on the New York Stock Exchange, marking an intraday decline of 11.58% from its previous market high. While most retail traders logging into their mobile apps are hyper-focused on this double-digit single-day pullback, thinking the telecom giant is losing its footing, the real story is happening beneath the surface in institutional whale positioning. While the daily chart looks like a steep drop, big block trades on advanced institutional systems tell us that massive funds are actually accumulating Nokia shares on this dip, treating this sell-off not as a fundamental breakdown, but as a highly strategic entry point to capture forgotten infrastructure value. The broad market narrative is that this company is a slow-moving legacy hardware provider permanently stuck in the shadow of sexier silicon names, but the underlying operational data suggests a massive gap between public perception and actual technical positioning. When most people talk about Nokia stock today, they picture the old plastic brick phones from the late 90s, or they assume it is just a struggling European utility company trying to compete for scraps in the global 5G hardware market. If you ask the average retail trader using basic online investing strategies, they will tell you that the stock is dead weight compared to high-flying software plays, or they might confuse it entirely with a meme asset that spikes randomly without institutional backing. This common assumption is exactly why so many investors miss out on major infrastructure shifts until the price has already doubled. The general consensus says that legacy networking hardware is a low-margin commodity business with zero growth potential, forcing investors to park their capital in massive cloud providers instead. But the reality challenging this narrative is that artificial intelligence models cannot live in a vacuum. They require insane amounts of high-speed optical and routing bandwidth to communicate across data centers, and that exact physical plumbing is where Nokia is silently winning massive multi-billion-dollar routing contracts. To truly understand what is driving the massive trading volume we witnessed during the May 29th session, where over 113 million shares changed hands, we have to look closely at the broader sector momentum and recent macroeconomic pressures. Over the past month, Nokia stock has put on an absolute clinic in volatile upward mobility, climbing from roughly $13.30 at the start of May to a multi-year peak near $15.68 just days ago, before this sudden 11.58% correction flattened late-stage buyers. This recent surge was driven by massive earnings surprises and structural breakthroughs in high-speed optical routing, forcing institutional desks at major firms to aggressively re-weight their telecommunications and networking portfolios. When you look at the major brokerages or active trading platforms, you notice that large block orders have been consistently hitting the tape on days when the price pulled back to support levels, which points to programmatic institutional accumulation. Comment below how many shares of Nokia stock you currently hold, or if you are entirely focused on pure software plays instead. This massive volume surge proves that this is no longer just a sleepy dividend pair. It has converted into a highly liquid vehicle for serious macro capital allocation. The daily swings we are observing right now are heavily tied to the massive tension between high capital expenditure requirements for global telecom providers and the immediate, desperate demand for private enterprise cloud networks. While traditional telecom carriers have slowed down their regional 5G buildouts over the past year to balance their balance sheets amid high global interest rates, large enterprise data centers have picked up the slack, demanding massive upgrades to ultra-fast fiber optics and terabit routing systems to prevent massive data bottlenecks. This structural shift explains why Nokia stock has experienced such aggressive single-day moves, as the market tries to balance soft operator spending against explosive cloud infrastructure demand. Institutional players using specialized self-investing tools or checking advanced analytics through deep institutional portals are recognizing that the corporate gross margins on these cloud routing contracts are significantly healthier than traditional cellular base station contracts. This margin expansion is the fundamental catalyst that short-term retail traders are completely missing when they panic sell during an intraday downswing. Let us unpack the exact business architecture that underpins this whole equity thesis to see how this legacy titan actually generates its massive global revenue streams across different geographic regions. The modern corporation operates through three core operational pillars: network infrastructure, mobile networks, and cloud and network services, alongside an incredibly lucrative intellectual property division known as Nokia Technologies. The network infrastructure business is the quiet powerhouse of the entire investment thesis, encompassing fixed fiber networks, submarine undersea cables, and advanced IP routing hardware that links massive
massive global data hubs together. When a massive hyperscaler expands its computing cluster, it cannot simply rely on standard cables. It requires highly sophisticated proprietary silicon architecture to route data packets without massive latency spikes, which is exactly the hardware Nokia builds. Their mobile networks division focuses on the macro base stations and cellular radios that power public mobile connectivity, a business that acts as a stable, highly cash-generating foundation despite the cyclical nature of global carrier investment waves. To get an accurate perspective on how we arrived at this current $14.84 USD valuation, we must briefly look at how the company restructured its entire operational model following the massive carrier spending cliff of the early 2020s. For years, the company suffered from an incredibly bloated comfort structure and severe integration hangovers from its past acquisition of Alcatel-Lucent, which diluted its earnings per share and turned off premium institutional allocators. Management responded by cutting thousands of redundant corporate positions, spinning off non-core assets, and directing billions of dollars straight into core research and development for specialized networking silicon. This aggressive turnaround strategy completely revived their balance sheet, transforming the business into a lean, highly efficient cash machine with billions in net cash reserves and zero immediate debt maturities. This clean financial foundation is exactly why conservative long-term wealth managers look to include names like this in structured models, appreciating the strong defensive moat combined with unexpected infrastructure upside. Looking forward into the second half of 2026 and beyond, the future outlook for Nokia stock hinges on a few distinct operational catalysts and clear risk scenarios that every self-directed investor needs to weigh carefully. In a bullish scenario, the explosive expansion of private enterprise data centers continues to accelerate at an exponential pace, forcing global technology companies to deploy Nokia's high-margin terabit routing platforms to handle the intense data throughput. This would drive an absolute blowout in corporate gross margins, pushing their trailing price-to-earnings ratio down from its current elevated levels and forcing a massive structural re-rating of the equity towards software-like multiples. On the bearish side of the equation, the persistent weakness in broader carrier capital expenditures could linger longer than expected if global macroeconomic growth slows down, capping the revenue upside of the mobile networks division and forcing the stock into a prolonged horizontal trading range. The key to navigating this asset is tracking the explicit ratio between legacy mobile hardware revenue and high-margin optical routing sales over the coming quarters. When you look at how this entire investment narrative fits together, the massive contrast between popular market expectations and hard operational reality becomes incredibly clear to anyone willing to look past the daily tickers. The broader public continues to view this asset as a stale relic of mobile history, expecting it to slowly drift sideways while capital flows into hyperscalers and semiconductor giants. The deep operational reality shows a debt-free infrastructure titan holding vital patents and providing the literal physical plumbing that prevents modern cloud computing networks from collapsing under their own data weight. By entering the market with this expectation versus reality framework, you can clearly see why the massive single-day drop to 14.84 USD is being treated by institutional funds as a rare opportunity to accumulate core asset pieces at a deep structural discount. Ultimately, the long-term trajectory of the stock will not be determined by daily retail trading sentiment on mobile apps, but by the relentless, cold necessity for physical bandwidth in an increasing data-hungry world. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.